How credit card interest really works. To understand why a 10% cap is so controversial, you first need to understand how credit card interest is actually set. Most credit cards don't have a fixed rate. Instead, they follow a simple formula: the prime rate plus a margin set by the card issuer. Right now, the prime rate sits well above where it was just a few years ago, and that increase has passed almost directly to consumers. When the Federal Reserve raises or lowers its benchmark rate, credit card interest usually adjusts within weeks, sometimes without any special notice required. That's because most credit card agreements are written to automatically track changes in these benchmark rates. And here's the part many people don't realize. Credit cards don't just charge interest monthly, they calculate it daily. If you carry a balance, interest accrues every single day, based on your average daily balance over the billing cycle. That's why even small balances can quietly grow over time, and why high rates matter so much. At roughly 20% APR, someone carrying a balance for years can end up paying more in interest than they originally borrowed, even while making regular payments. A 10% cap, even for just 1 year, would significantly slow that process. But it wouldn't change it for everyone in the same way. Who benefits and who might not? For consumers who already have credit cards and consistently carry balances, a temporary rate cap could translate into immediate relief. Lower interest means more of each payment goes toward the principal instead of finance charges. Over time, that can shorten payoff timelines and reduce total interest paid. For people on the edge, those relying on minimum payments, the difference between 20 and 10% isn't theoretical. It can be hundreds or even thousands of dollars over the life of the debt. But critics argue the benefits may be uneven. Lenders price risk into interest rates. If that pricing flexibility disappears, issuers may respond by approving fewer new accounts, lowering credit limits, or focusing only on borrowers with the strongest credit profiles. In other words, the people who benefit most from lower rates could also be the most vulnerable to losing access to credit altogether. This tension between affordability and availability sits at the heart of the debate, and it explains why even within the financial industry there's no single unified prediction of what would happen next. Why this is happening now, the timing of this proposal isn't random. Affordability has become one of the dominant economic concerns in the United States, cutting across income levels and political affiliations. While inflation has cooled from its peak, many households are still adjusting to higher prices and higher borrowing costs across nearly every category, from housing to transportation to everyday expenses. Credit cards have become a pressure valve. They allow people to smooth out short-term costs, but at a price that has risen faster than many expected. That's why this proposal resonates politically. It's easy to understand. It targets a visible pain point, and it can be framed as temporary rather than structural. But it also raises a bigger question about the role of government in setting the price of private credit. A question that goes far beyond 1 year or one interest rate. The unanswered question. So what happens if this actually moves forward? Would issuers adapt without cutting access? Would consumers see real relief or just short-term breathing room? And would a 1-year cap set expectations for something more permanent? Those questions don't have clear answers yet. What is clear is that this proposal has already shifted the conversation. Credit card interest rates, once treated as background noise, are now a front-page economic issue. And as policymakers, regulators, and lenders weigh their next moves, one thing is becoming increasingly apparent. This debate isn't just about lowering a number. It's about redefining the balance between consumer protection and financial risk. Outrow, what comes next? Over the coming months, attention will turn to how or if this proposal becomes policy, and whether it remains a one-year experiment or evolves into something more lasting. The next phase won't be decided by slogans or social media posts, but by negotiations between regulators, lawmakers, and the institutions that control access to credit. And in the next video, we'll break down a closely related question that could affect borrowing costs even more directly. What happens if interest rates start falling, but credit card rates don't follow? Because history suggests that gap matters more than most people realize. If you want to understand how that mechanism works and why it could shape the next phase of consumer debt, that's where we'll go next. Moses limi pripemiti scriptus a copy-pastu algro direct. Bez de morum cooperati segment po segment. Naravno. Ispad j jeden stevina, continuerna tiet scripta. Pot puno spojeno jeden text. Bez naslova. Bez pauza. Bez segmenata. Spremna za directen copy-pastu algro. Zajuro samad safe ton. Neutralogen zeziki predon retom zi voiceover. What if the interest rate on your credit card suddenly dropped to 10%? Not someday in the future, but this year, and only for 1 year. That's the idea President Donald Trump has just put back into the spotlight, urging credit card companies to cut their interest rates nearly in half. At a time when millions of Americans are carrying balances at historically high costs, the proposal sounds simple, almost obvious. But behind that single number, 10%, is a much bigger question. Would this actually help consumers? Or would it quietly change who gets access to credit at all? Because while lawmakers from both political parties are lining up in support, the financial industry is warning that the consequences may not look the way people expect. And one of the most important details is this. The plan may not even require Congress to move forward. Right now, the average credit card interest rate in the United States is just under 20%, according to publicly available Federal Reserve and bank rate data. Not long ago, it was even higher, passing 20% and setting a record. That means a 10% cap wouldn't be a small adjustment. It would represent a dramatic reset in how expensive everyday borrowing has become. In a recent public statement, President Trump called on credit card companies to stop charging what he described as excessive interest, arguing that rates between 20 and 30% had gone unchecked for years. He said a temporary cap would give consumers breathing room while sending a clear message to lenders. According to his comments, the proposed cap would begin on January 20th, 2026, marking 1 year since the start of his second term. The timing here matters. Americans are now carrying more than $1.2 trillion in credit card debt, the highest level ever recorded. Studies show the average household that carries a balance owes more than $10,000. For supporters of the proposal, this is not about punishing banks. It's about slowing a debt cycle that has quietly accelerated as interest rates rose across the economy. What makes this moment unusual is the political alignment. Long before this latest statement, the idea of a 10% cap was already circulating in Congress. Republican Senator Josh Hawley and Independent Senator Bernie Sanders introduced legislation together proposing exactly that. In the House, similar measures have been supported by lawmakers from opposite ends of the political spectrum. That kind of bipartisan agreement is rare, and it signals something important. Rising interest costs are no longer being treated as a niche financial issue. They are being framed as a broad affordability problem, affecting working families, small business owners, and even middle-income households. that once used credit cards as a short-term tool. Supporters argue that credit card issuers remain profitable and that current rates exceed the actual cost of offering credit, citing findings from consumer protection agencies. From this perspective, a temporary cap is seen as a correction rather than a disruption. But that is only one side of the story. Banks and credit card issuers have pushed back strongly, warning that a one-size-fits-all cap could reduce access to credit, especially for borrowers with lower credit scores. Their argument is straightforward. Credit cards are unsecured loans. Unlike mortgages or auto loans, they are not backed by physical assets. Higher interest rates, lenders say, help offset the risk that some balances will never be repaid. If rates are capped too low, issuers may respond not by absorbing losses, but by tightening approval standards. Some estimates suggest that millions of households who currently carry balances could see their credit limits reduced or their cards canceled altogether under a strict cap. Others warn that consumers denied traditional credit may turn to less regulated alternatives that often charge even higher rates. Even some high-profile supporters of President Trump have expressed skepticism, arguing that good intentions do not always produce good outcomes when credit markets are restricted. To understand why this debate is so intense, it helps to understand how credit card interest actually works. Most credit cards use a variable rate formula based on the prime rate, plus a margin set by the issuer. When the Federal Reserve adjusts its benchmark rate, credit card interest usually follows within weeks, sometimes without special notice. Interest on credit cards is calculated daily, not monthly. If a balance is carried, interest accrues every single day based on the average daily balance. That's why high rates matter so much, and why even small balances can grow over time. At roughly 20% APR, someone making only minimum payments can end up paying more in interest than the original amount borrowed. A 10% cap, even for just 1 year, would significantly slow that process. For consumers who already have credit cards and consistently carry balances, the impact could be immediate. Lower interest means more of each payment goes toward the principal instead of finance charges. Over time, that can shorten payoff timelines and reduce the total cost of debt. But critics argue the benefits may not be evenly distributed. If issuers respond by approving fewer accounts or limiting credit to only the lowest risk borrowers, some consumers could lose access altogether. This tension between affordability and availability sits at the heart of the debate. The timing of this proposal is not random. Affordability has become one of the dominant economic concerns in the country. While inflation has cooled, many households are still adjusting to higher prices and higher borrowing costs across housing, transportation, and everyday expenses. Credit cards have become a pressure valve, allowing people to manage short-term needs at a price that has risen faster than many expected. That's why this idea resonates. It's easy to understand, highly visible, and framed as temporary rather than permanent. But it also raises a deeper question about the role of government in shaping the cost of private credit. As of now, it remains unclear how a 10% cap would be implemented. There is no confirmed executive action, no finalized legislation, and no clear enforcement mechanism. Even so, public pressure alone can influence behavior, especially when bipartisan momentum is building. This debate is not just about lowering a number. It's about who controls access to credit, how risk is priced, and what affordability really means in a high-interest economy. In the months ahead, attention will turn to whether this proposal becomes policy and whether it remains a one-year experiment or sets expectations for something more permanent. And in the next video, we'll explore a closely related issue: that could affect borrowers even more directly. What happens if overall interest rates begin to fall, but credit card rates do not follow? Because history suggests that gap may matter more than most people realize.